Ever look at mortgage options and feel like you are reading a foreign language? I hear you, but don't worry. By the end of this video, you will be fluent in mortgageese. Stick around. Hey, welcome back to the channel. If you are new here, make sure to hit that subscribe button to stay tuned for all things home buying. Now, today we are diving deep into mortgages. But before I get too far into this video, I get people reaching out to me all the time looking to buy or sell. It's people just like you watching this video. So if you're looking to deal in real estate, make sure you get in touch. I am so excited to help. You can call or message me and I will leave my details in the description below. We are breaking down the terms, dissecting rate options, and showing you how to save some serious cash in this video. So grab your notepad. This is going to be jam-packed. Understanding mortgages. A mortgage isn't just a loan. It is a long-term relationship with a lender. You're going to be together for a while, so you need to make sure that you understand exactly what you're getting into. It's not just borrowing some cash to buy a home. They give you tons of paperwork, you sign it, and you are committed to those terms for the long term. No, it's way more than all of that. Think of it like the most important financial decision that you'll probably ever make. It's a commitment. Kind of like marriage, but to a bank. Let's break down these options. Before we jump into the type of mortgages, let's talk about mortgage insurance really quickly because it will come up shortly and I want to make sure you have some context. This is insurance that you pay, but it protects the lender if you default on the loan, aka you stop making your payments. Typically, you have to pay this if you're putting down less than 20%. Now that you're in the know, let's explore these mortgage options. 20% down, the conventional way. First up, the old school, tried and true, the 20% down payment. All right, so putting down 20% might seem like a huge amount, but let's talk about why it's worth considering maybe holding off and saving up some more money. Now, why would you want to part with that much cash up front? For starters, you bypass that pesky mortgage insurance that we just talked about. It costs money, typically tens of thousands of dollars. Another perk, you might even snag yourself a lower interest rate because lenders see you as less of a risk. Now, here's the most important thing. Most people think that 20% down payment route is just for those who have owned a home before. And you might wonder, why is that? Well, it got that reputation because typically people who are buying their second or third home have built up enough equity in their previous homes to afford that larger down payment. But hey, if you're a first-time buyer and you've saved up, you can totally go this route too. Don't have 20% lying around? No biggie. You can go the insured route. And with the insured route, you can put down as little as 5%. First things first, let's bust a myth. A lot of people think that this route is just for first-time home buyers, and that couldn't be further from the truth. Whether you're stepping into homeownership for the first time or coming back for round 2 or 5, you can take this road. Now here's the deal. Going the 5% down route means that you will have to pay for mortgage insurance. Remember that little chat we had earlier about it? Yep, that's coming back around. But don't see it as a negative. Actually, what enables you to get into a home with a much smaller down payment. Think of it as the cost of getting a mortgage. What's super cool is that because you're putting down less upfront, you might have extra cash to do some immediate home improvements. Want to build that dream kitchen you've been eyeing on Pinterest? Well, now maybe you have some funds to do it. Or perhaps you could pay off some debt and put yourself in a better financial situation. Or maybe that's just all the cash you have right now that you've bought a home, and that's okay too. Now you can just start building that sweet, sweet equity. But be cautious. A smaller down payment means a larger loan amount. And a larger loan amount means, you guessed it, higher monthly payments. So do the math. Figure out your budget. Make sure you're comfortable with what you'll owe each month. So you've got the 20% down for the mortgage OGs and the 5% down for the folks who want to keep some cash for those IKEA runs or just get into a home sooner. But what if I told you you could actually skip the savings altogether? Yes, it's not a fairy tale. It's the Skip the Savings program. Now, hold your horses. I know it sounds too good to be true, but there are some caveats. First off, skipping the savings does not mean you get a free pass on credit checks. Now, you still have to have decent credit, and you should expect your monthly payments to be a bit higher since you're essentially borrowing 100%. For this program, I also do require a buyer consultation. Why, you might ask? Because it's a big commitment and it's not for everyone, and we want to make sure that it's the right program for you. In a buyer consultation, we're talking terms, conditions, the whole shebang, making sure that you know exactly what your options are and if it's even a possibility for you right now. Something else to consider is that you're borrowing the full amount, which means that you're likely paying more in interest over the life of the loan. So you've got to weigh those pros and cons. And most importantly, you have to be financially prepared for this route. Now, you're practically a mortgage Jedi, but the force needs to be balanced. So let's move on to the eternal struggle: fixed versus variable rates. Fixed rates. So now if you're the kind of person who loves predictability, you want to know what's coming around the corner, then fixed rates just might be your jam. But what exactly does it mean to have a fixed rate? Simply put, your interest rate will remain constant throughout the term of your mortgage. Whatever the term is, 2, 3, 4, 5 years, it stays the same. There's no surprises, no sudden spikes, just good old consistency. Imagine you're at a buffet and you find a dish you absolutely love. With a fixed rate, it's like that dish stays exactly the same every time you go back. Amazing, delicious, and completely reliable. Sounds awesome, right? Now, the consideration here is that oftentimes fixed rates will be a bit higher than variable rates at the outset. And that's because you're essentially paying for the stability and the peace of mind that you get with having that consistent rate. It's like buying an insurance policy against rising interest rates. What people often overlook is that with a fixed rate, budgeting becomes so much easier. Your mortgage payment stays the same each and every month, which means you can plan your finances without worrying about what the Bank of Canada is going to do next. So if you're the type that wants to set it and forget it, this could be the perfect choice for you. Now, the other thing that I want to put out for consideration is that fixed rates often come with stricter penalties if you decide to break your mortgage early. So if you're eyeing this option, make sure you're committed. If you buy into a 5-year fixed term, there is payout penalties to sell your home earlier. It's kind of like a long-term relationship. You want to be sure before you say, I do, because if rates fall, you are watching from the sidelines, stuck with your higher rate. Now, variable rates. Okay, thrill seekers, this one is for you. If you ever wanted to ride the roller coaster of interest rates, then step right up and consider a variable mortgage rate. But be warned, this is not for the faint of heart. With variable rates, nothing is set in stone. 1 month you could be scoring with super low interest, and the next you might be digging a little deeper into your pockets. Think of it as a gamble, like playing blackjack in Vegas. Some people will opt for a variable rate hoping that they will go down and that they can lock in at a better rate. Sometimes you win big and sometimes you lose your shirt, and it's all about your appetite for risk. Now, variable rates generally start lower than fixed rates. That's the draw. That's the sparkle that catches your eye. But remember, it's variable for a reason. The rate changes based on market conditions. And if those rates spike, there is no turning back. There is no do-overs. You are locked into riding that wave wherever it takes you. And let's get real. These rate spikes are not just minor inconveniences. They can and do significantly affect your monthly payments. And for what? The possibility of maybe, just maybe, getting a better rate at some point? It's like betting on a long shot at the racetrack. Sure, the payoff could be big, but you have to decide if you're willing to take that risk. So if you're eyeing variable rates, you better be comfortable with uncertainty that comes with it. You're basically agreeing to ride the real estate wave. That's ups, downs, and maybe even some gnarly wipeouts. Before jumping in, ask yourself, am I ready for this roller coaster? So you've heard all about fixed rates and variable rates, but you're still on the fence, huh? No worries, I've got you covered. Let's break it down into a simple pros and cons list so you can see what you're really getting into. Fixed rate. Pros: stability, stability, stability. Your rate stays the same, making budgeting easier. There is no need to lose sleep over rising interest rates. You are nice and cozy in your little interest rate bubble. And it's a set it and forget it deal. It's perfect for those who don't like surprises. Now let's move on to the cons. Potentially higher initial rates compared to variable rates. You do pay extra for that peace of mind. And if interest rates go down, you are stuck paying the higher rate you initially agreed to. Breaking your mortgage early? Get ready for some hefty penalties. Variable rates. Let's move on to the pros. Lower initial interest rates. It's like that intro offer at the swanky gym. The potential for savings if interest rates go down or stay the same. And you get more flexibility, usually with lower penalties if you decide to break your mortgage early. But you can lock in at any time. Cons. Uncertainty with a capital U. Rates can change and not always in your favor. Budgeting becomes a game of Wheel of Fortune with less glitz and more stress. If rates spike, you're left holding the bag. There's no turning back, there's no mulligans. So there it is, the pros and cons of fixed versus variable rates, laid out just for you. Remember, the right choice depends on your own financial situation, how much risk you're willing to take on, and how long you need the mortgage for. Don't be swayed by what your buddy or your aunt says. Make sure you do your own research and maybe even chat with your first-time buyer bestie. Hey, that's me. Before making a decision. All right, we've been through a lot today, and I hope this helps demystify the complicated world of mortgages for you. They are a big, huge, long-term commitment, but knowing your options and being educated about the process can save you both money and stress. So if you're feeling enlightened, hit that like button and subscribe. Join me for all of these real estate adventures. I've got more home buying wisdom coming your way. Bye.